Chandrasekhar from the IMC Chamber of Commerce and Industry. The IMC Chamber of Commerce is a 115-year-old institution, Chamber of Commerce in India, one of the pioneers in this space. The members of the IMC have contributed to generation of enormous amounts of wealth, okay, over the last century and more. And the IMC chamber has several expert committees. It's always led by some top industrialists or a top professional. And this year on the managing committee, of course, we are quite fortunate to have a very senior person, a financial market wizard, a financial market expert in, of course, our Anand Rathi Saab. But let me say something more. I have two speakers today. We have two speakers today, absolutely elite speakers. And over the next 2 or 3 minutes, I want to share with you a few sentences about these people, about these two elite parents. Actually speaking, it would be a little presumptuous on my part to even introduce somebody like Anand Rathi. But yet there is always a joy, there is a pleasure in talking about people we know. And therefore, I want to derive the joy of talking about Mr. Anand Rathi, who's the chairman of Anand Rathi Financial Services. And he's one of the leading financial market and investment experts, not just in India, possibly in Asia, in my view. Brilliant academic career, gold medalist, chartered accountant, and all that. 50 years plus in this profession. He's also had corporate experience, without any doubt, and he established Anand Rathi Financial Services probably about 3 decades ago, 1994. But he rose to become the president of the BSE, Bombay Stock Exchange, in 1999-2000. That was exactly the time the Y2K problems hit the global market. And I'm sure it must have been a hugely challenging time for him. And then he was the driving force behind setting up the Bolt, the BSE online trading system, etc. And of course, he's initiated various reforms there. And therefore, today, under his leadership, Anand Rathi Financial Services is doing extremely well. It's a full service integrated financial services company offering a wide range of financial services. And of course, it has a footprint over 350 locations within India and outside. Rathi Saab, we are truly honored by your presence. Thank you very much for consenting to be a part of this event of IMC and MCX. I'll say a bit about the relationship between IMC and MCX after I talk about Professor Alok Pandey, Dean, School of Management at GD Goenka University. Again, an awesome academic, more than 25 years of experience. He's been at fairly senior levels, including leadership roles. He's authored books, edited books, and his articles have appeared in print in so many prestigious publications. And of course, Professor Pandey holds a master's degree in management, and of course, a PhD in international finance and several others. It's a very impressive, long and impressive list of accomplishments. So these two elite personalities have actually decorated our events this afternoon. I'm so delighted that they are here. We are going to be discussing managing global economic headwinds using commodity derivatives. And before we begin, before I invite Mr. Rathi to speak, I must mention two things. IMC Chamber of Commerce and Industry is a SEBI accredited training institution for commodity derivatives. Across India, the SEBI has recognized about 20 or 22 institutions as training institutions for commodity derivatives, almost all of them are actually educational institutions. The IMC Chamber of Commerce is the only Chamber of Commerce in India with the SEBI accreditation, that it's a training institution for commodity derivatives. This is one part. The second point I want to talk about MCX. All of us know, of course, MCX is India's largest commodity derivatives exchange, massive market share in metals, in gold and silver, base metals, and in energy products, crude oil, and of course in select agriculture commodities, cotton, palm oil, etc. Hugely successful commodity derivatives exchange. IMC and MCX shook hands and came together some 4 or 5 years ago. And since then, we've been doing a number of events to create awareness about commodity derivatives market, about on hedging, on risk management, on market outlook, covering energy products, metals, agriculture, etc. And therefore, this event, today's event, is a part of that ongoing series of events that IMC and MCX have been engaged in. Today's topic obviously is very clearly managing global economic headwinds with commodity derivatives. And let me just flag that issue. All of us know the kind of headwinds that the global economy is facing. And I have authored a number of articles and spoken in conferences about how in the last 5 years, 3 tidal waves have actually swept this world and the global economy. It started with the US-China trade war 2018-19. Then came the COVID-19 pandemic 2020 and 2021. And just as we thought that we are going to get out of all this, came the Russia-Ukraine war early this year, end February, March 2022, and it's going on. That's the most surprising thing. And therefore, that has led to a number of consequences. Over the last 4 or 5 years, the markets have not been what they used to be. And that's creating huge amount of challenge, huge amount of uncertainty for market participants. And in whichever asset class people invest, they are facing challenges. And therefore, with this preliminary remarks, I'm going to invite Mr. Anand Rathi. But before that, Rathi Sahab, allow me just 1 minute. I want to recognize the very august presence of our friend, a very senior person in this industry, Dr. B.B. Patnaik. Dr. B.B. Patnaik, I'm sure today is in Delhi. He used to be he was the chairman of the Central Warehousing Corporation. He was the chairman of the National Seeds Corporation and several other institutions. Actually, I've lost count of the number of positions he has held in the last 25, 30 years. And we have known each other. Patnaik Sahab, welcome. I'm so happy you are here. The other person I want to recognize, of course, is Naveen. Naveen and I have known each other for long years from the time he entered this commodity space. And Naveen, I'm delighted to see you here. And with this, let me hand over the baton to Sri Anand Rathi. Sir, the floor is yours.
Thank you, Mr. Chandrasekhar. And first, let me compliment you for organizing a very, very, very pertinent topic at the moment when everybody is, really facing a lot of challenges in what you're doing and a lot of uncertainty, particularly, people are still not able to make out what's going to happen.
Absolutely.
So my compliments to you.
Thank you.
And obviously, thanks to Indian Merchant Chamber. Of course, I'm being a part of the managing committee, so I always feel proud whenever Indian Merchant Chamber is able to organize programs like this and, have the various participants to discuss very, very, important topics. I also am very happy to have, joining Professor Alok Pandey, about whom I heard just now. I think it would be great to hear him and learn from him. And before I talk of the topic, of course, let me welcome you, all the participants today. And I hope that today's session would be very, very useful. Now, as the topic suggests, we're talking of managing global economic headwinds using commodity derivatives. So first key thing which you're talking is the economic headwinds. What are the headwinds we are having today? And obviously, once you understand them, then we could see how could commodity derivatives help in this situation. Now, I think, in my such a long experience of more than 50 years, this time is a very, very different time. And such times we have never seen before. And also particularly as Mr. Chandrasekhar mentioned, we have three major events in the last 4 or 5 years. And each one of them changed the entire trend in the market, entire economic situation. So I think, 1819, of course, big war between US and China trade war created a lot of uncertainties on so many things, which had impact on the commodity prices, businesses. Came 20, of course, when pandemic came, first fear obviously was the demand fear, and therefore, the prices went down. All the central banks at that time wanted to give more money to the market. They distributed money like anything. I think countries like US, which is the largest country to push the economic, direction in the world, they almost doubled their balance sheet size. They put more than $3 trillion in the hands of people. Because at that time, the pandemic had created a concern. How will we survive this pandemic? How will people survive? And therefore, most of the governments, US government, UK, Europe, most governments started paying money to, to workers, to other employees, to businesses, and, free money. I think US guys never had such good thing before, that there's a windfall coming to the bank account without knowing where the money is. So you're getting $2,000 every month like that. So that, first of all, the fear was that demand will go down, and therefore the, all the prices, most of the commodity prices went down very sharply. Then the entire thing reversed because the supply constraints came during pandemic, and therefore supplies started reducing. But because of the money distributed, the demand started going up. Okay. And that demand obviously then pushed the prices of all the commodities, and most of the commodities had perhaps best ever prices, or the closer to best ever prices during 21 particularly, and then the inflation went up. Obviously, when demand goes up, money is free, money was available, so inflation went up. And therefore, then central banks started worrying about the inflation. And then they started working, I think till 2018 or 19, US was reducing its interest rate, brought it down to closer to 0 or 0.25%. And then suddenly 2022, the March, the US Fed realized that no, interest rates need to increase. So they started increasing rates by 25 basis points. And the trend in US always been that whenever there was an increase or reduction, it was 25 basis points. Okay. And that was the thought process. But then when inflation started going up, they immediately in the month of May, they went to 50 basis points. And then in the month of June, they thought, oh, this is also 75 basis points. These sort of increases have never been seen before. Such, of course, the interest rates in US had, at one time, I was in US at that time. For some reason, the interest rates had gone to, in 1980. Many of you may not be aware, it has gone to 20%.
Oh my God.
The Fed rate was 20%. I don't know how many of participants would have ever heard that. But I seen that. But of course, here, so almost we have come to 4%, and the inflation seems to have now peaked out. Okay, it is being realized that almost around the world, the inflation has peaked out, and therefore yesterday the Fed indicated that the interest rate now, the increases may be slower. Not that it would be there, it would be slower. So I think we'll see further few increases. And to my mind, again in 23, you will start saying because the growth is affected, recession has come, then there will be reverse cycle will start of reducing the interest rates. So we will see those cycles. Now, talking about India particularly, even India central bank was under pressure to increase the interest rates. I think more because, not to my mind, not because of inflation, but because of the exchange rate. Because when the US interest rates gone so high, most of the money started flowing into the US. And when interest rate differential happens, this is, the availability of money to the country goes down. So we had also increased interest rates, but even in good thing in India was in the last monetary policy committee, some members thought that the increase should not be that high. It should be restricted. And one member, noted member, Mr. Verma, even said that perhaps we may not need more increase. So I think on the whole now scenario on the world is that inflation has peaked out. Interest rates, I think maybe few 1 or 2 or 3 more increases. After that, it will be stabilized or start going down. We are heading for recession. The challenge, what is the headwind? Now the world is talking of recession because of huge interest rates. When it go up, demand will come down. In the meantime, when pandemic we have recovered from there, the supplies started increasing, obviously, So on supply side, there has been better supply on the metals or any other thing. Of course, Russia-Ukraine war created problem in supply of food grain particularly, okay? Because about 30% of the food grain exports are from Ukraine and Russia. So that affected the agriculture product markets hugely. And oil in a way, because Russia is one of the largest producer, so it affected the oil prices also, June. But now we have seen in last 1 month, the trend is now changing. Most of the metal prices started coming down. Even food prices are now slightly coming down. Oil prices, as we have seen, is significantly lower from the high which has reached 3-4 months back. So I think going forward, the problem is the total trade. The economic hike won't be that the recession may come and therefore demand may go down in recession. And I am now going to talk more from Indian angle, that how it's going to affect us. Okay. And I think to my mind in India, the effect would be our exports definitely are getting affected globally. But very good part is that our economy is doing very well. And I think this is for the first time we are able to see that our growth pattern is entirely different than the global growth pattern. Our economic growth is the highest in the world and is likely to continue to be so for many more years. And therefore, our challenges are that, when the interest rates have increased, also the variation in the volatility and the commodity prices, what is affecting us, that you cannot easily forecast the commodity prices. The volatility in the commodity prices has been very, very high in last 2 years. The volatility has gone very high. Most of the time, every time volatility about, 10 to 20% volatility in any normal year is expected. But last 2 years, we have seen volatility of more than 20%, 25%, even 30% volatility. And this is where I think the big challenge for the Indian businesses is how to manage this volatility on commodity prices, particularly if your business is largely affected because of the commodity prices. Either you're consuming raw material as a commodity or you're selling commodity as your finished product. I think objective of any business is that it should be able to manage its profitability. It should be manage its cash flows. And when prices of raw materials or finished goods vary so sharply, I think that's a big challenge for any business, how to manage that. Because your production cost, they don't vary that much. They are in your control. You can manage it very well. You can forecast it very well. But how do you do the forecasting on the raw material prices or the commodity prices? That's a very difficult task because there are so many different currents in the global markets which keeps on changing. And you have seen that, one day prices, commodity prices start coming down, and suddenly next day you find out it start going up again, because the global situation changes, the inventory carrying is changes, or some policy change by some government, by US or China. So all these have cumulative effect on the commodity prices, and therefore important today in many companies, the margins are far lower than the volatility in the commodity prices. And therefore, challenge for them is very big. That if your margins are only 10% or 5%, and the prices can vary by 20%, how do you manage your profitability? So I think that is where the role of derivatives is very, very important. I think, in derivatives can help you at least to manage your risk. The derivatives is a big tool of risk management, and obviously is a tool for hedging your risk. And it is very important for Indian industry to adopt it. I am aware that even now, I think not many companies have taken to derivatives, and therefore are facing huge challenges in their profitability. And even in while our turnover in the commodity market has gone up very high, we could be really proud of that. But on the other side, very small part of the turnover is contributed by the real industry, consumers, businesses who are concerned and affected by these prices, because they are not traders, they are manufacturers, and manufacturers have to manage the risk by hedging if prices of raw materials or finished goods go up or go down, it should not adversely affect their business interests, their profitability. And that's where the role of, I think, derivative is very important. I think what is important is that every company, every business must have a very clearly defined hedging policy, the risk management policy, and see that how much, either to buy or sell, whatever is their need, they are able to hedge it on the market. Of course, even today our markets are not so much, still very developed, and particularly while our futures are quite significant, we still have long way to go on our options. Absolutely. And more importantly, even long way on the long-term options. Yes. I think, any industry which has 3 to 6 month cycle of raw materials or finished goods, they need hedging for a longer period. Absolutely. Which is still, unfortunately, is still not available. It would happen, I think. Everything takes time. And that's where I think, I believe the role of our chamber is to see how do we, apprise our members, our other businessmen, to understand these hedging practices, the derivatives they understand, take proper exposure in that. Many companies which where I've been associated as consultant, I insisted that your commodity needs, either sale or purchase, must be hedged, effectively hedged. And I think that is where the role of derivatives is very important. I am sure that as the time goes, people will realize the importance, and they would like to see that they use the various derivative products available on the Indian exchanges. Government even allows doing hedging on the outside exchanges. Even that, those who need to do it and they are allowed to be done, I think they should not hesitate to do it. But friends, I strongly urge everyone that please don't take this risk. Otherwise, you'll become a trader. You may become a speculator rather than a manufacturer. And ultimately, while your manufacturing may do very well, your sales may do very well, but you may not end up with the profits which you expect to do. So I think this is the broader background, friends, which I wanted to share with you. And we'll be happy to take any questions later on as Mr. Chandrasekhar thinks proper. So thanks again, Mr. Chandrasekhar, and back to you, please. Thank you.
Sarji, thank you very much. I would actually say what you have given all the participants is a helicopter view of the commodity markets around the world, and of course the situation in India. Thank you very much. It's very important, and I'm sure our participants have absorbed a lot of what you have said. We will have some follow-up questions as we go along, time permitting, of course.
Yeah.
I'm now going to invite Professor Alok Pandey to share his thoughts on the topic. Professor Saab, the floor is yours. Unmute, please unmute.
Has to allow me. Yeah.
Yeah, perfect.
Yeah. Thank you. Sir, it was such a privilege hearing Mr. Anand Rathi. In fact, it's a dream for most of us who are into financial markets, teaching, learning, or doing some activity, whatever, to be part of a panel where Sir is speaking. I told the MCA people, you have made my life very difficult by making me speak after Sir. But Sir has definitely given a wonderful view of where the world stands, and effectively the way interest rate environment has changed over the last 30 years, considering that, the interest rates in US were very close to zero recently, and they were around 20% somewhere in 1980, as Sir mentioned. And most of the youngsters who are attending this would be surprised that in fact, in India also, we had a very high interest rate regime for a long time before liberalization. And post-liberalization, of course, the interest rates have been reflecting the economic environment through the monetary mechanism which the RBI has created. But one of the important points which I, during my course of learning, have felt, in fact, some of the research papers have mentioned that interest rates tend to have a very strong connection with the
I suspect, yeah, his network bandwidth is low, is the message that I'm getting. I suspect we have lost.
You've lost me?
Professor, yes, yeah.
It's okay now. Yeah.
The relationship between interest and something, whatever, commodity
Yeah.
prices.
I said interest rates and commodity markets because,
Right.
the basic point is that we have always felt that interest rates are a direct reflection of money supply in the economy.
Correct.
Right? And that comes out of inflation.
Correct.
Now, inflation, as it is seen, it is best viewed when you take data from the commodity futures markets. The way the commodity futures markets functions. Sometimes, if you take the exact, in fact, there's a paper, which I would mention here for the interest. This was a paper of Cornell and French, 1986, and they say that the short end of the term structure, can be extracted from commodity futures prices. And they say that the expected inflation in commodity prices, often increases whenever there is an increase in money supply. So largely the inflation levels in commodity markets, when they are organized in exchanges, they tend to be, we collect data more effectively. And when it comes to monetary policy determination, the data from commodity markets has to be taken into consideration, the changes in prices and other things. Often we use the CPI and WPI indices globally. Now, of course, the methodologies keep changing over a period of time. But this is high time that we realize this important idea. Now, another thing which Sir mentioned was the use of futures and options. And of course, let me just give this a more academic tinge and share a small PPT for the benefit of the audiences.
Please.
I hope it is visible, sir.
Yes, it is, of course.
Yeah.
Yes, yes, sir.
Visible? Yeah. Now, if you look at this idea of, can you see this?
Yeah, that's right. I think, yes.
So, largely when you look at the global economy today, as Sir said, I'll just paraphrase whatever Sir has said, or in terms of, I'll put it in an academic perspective. Now, if you look at the global economic headwinds, there are 4 or 5 major pointers. Pointer number 1 is the fall in manufacturing PMIs around the world, that is product manager indices.
Correct.
The second one is the declining consumer sentiment. The third point is declining business sentiment. Then is the tightening of monetary policies across the globe, G20 countries, and the result is fall in economic growth. If I may tell you, Now, all these basically are affecting the way economies function around the world. Now, we were expecting prior to COVID that, the world or this country would be moving at a particular rate of economic growth. But suddenly, yesterday's, I read recently, I think a month, I think 12th of October, IMF said that the global growth rate is going to fall to almost like half. And these are some of the major issues. Now, unless these issues are addressed and how well they can address, definitely we as a country are growing much ahead of the world and we are doing very well. But unless we catch these important ideas from around the world, we also may falter in our growth. Now, if you look at manufacturing PMIs across these countries, almost every other country has a fall in PMI. We were the only country which was doing reasonably well post-COVID, but that is probably because of the base effect.
That's right.
But as we grow forward, we need to really be careful because there is a supply chain crisis currently brewing, because there is a semiconductor crisis still. So our automobile, India being an automobile hub, we do have, largely when I look at the commodity markets, we look at precious metals, we look at metals which are used for manufacturing, we look for energy, and all of them, they come into the manufacturing of automobiles. All of them actually come in terms of, any high-end manufacturing, as we Honorable Prime Minister has said that India has to become a manufacturing hub. And majority of the businessmen have now started investing. And in fact, the latest data suggests that capital expenditure is on the way up. So if you look at the purchasing manager indices, these indices, the way they have fallen, they may keep falling unless the global headwinds are not taken into consideration. And that's where Sir's idea of companies which have a very strong hedging potential, do not have a hedging policy, will fail. If their margin is 10% and the loss due to hedging in commodities, because majority of the components and other things which are connected, they are connected to commodity markets, they work. The second is consumer sentiment, which probably was because of the pandemic. And post-pandemic, there was tightening of purses. In fact, in US, we first saw a great resignation, right? And then we found people getting jobs at whatever price they wanted. Now we are seeing great layoffs. I'm sorry, sir. My apologies. Now, the fact is that if we look at the way things have changed suddenly within a year, from great resignations, the employee point of view, where people had options, now to great layoffs, and now the advisory by the American government that please don't buy as much as possible, save money, and that is going to definitely hurt the companies even more as the consumption recedes. So the threat of recession is already looming large in most of the Europe and US, and we hope that probably something will be done. And this war, which has affected, one of the reasons after pandemic is this war, we'll be able to manage things. Third is business sentiment. Business sentiment largely would be connected with something like consumer sentiment, and as consumer sentiment falls, the business sentiment falls as well. So the other would be tightening of monetary policies. Now, as inflation went up, the countries, especially in US, the Fed, as everybody knows here, from 0.25 to somewhere around 3.25 now. And with after this Fed, Indian Monetary Policy Committee also went into action, and they have also gone up to a repo rate of almost like 5.9%. And added to that is the feature that dollar, despite our trying very best to keep the interest rate parity with the US Fed, we have seen dollar climbing up to almost like 81 to 82 rupees a dollar, say 82 rupees level. And that, has made another issue for us. What has happened is that despite there was a fall in crude oil prices, we could not benefit of it because the dollar prices went up. And that was the case for majority of the LDCs and developing countries. That, even if commodity prices, we've seen some high volatility in metal and energy prices, especially, the energy, natural gas and crude oil. So even when crude oil prices are almost, 74, the WTI Brent was 74 2 days back. And, suddenly you have a problem that we can't really lower the prices just because purchasing this price, this crude has been very costly for us. So majority of the countries, of course, are tightening their monetary policies. The interest rates are going to go up, and we do not know. Although the Fed has now signaled that the cycle would be a little slower and the rate of hike would be a little slower, but still the fact is that we may be affected. Now, the other issue, which is that, this has resulted in something like the latest data from IMF says that, from a 6% forecast to almost like 2.7% 2023, 6% 21, 3.2% 2022, and 2.7% 2023. And this, they say, is the weakest growth profile since 2001. So the fact is that added to this, there is something called inflation level rising. So inflation levels, they say, would rise from 4.7 to in 2021 to almost like 8.8, but decline to 6.5 and would fall to around 4.1%. So we have a real case of stagflation here. So we have inflation and we have recession both coming together, and we need to be careful about it. Now, what were the real reasons for it? Everybody knows, and Sir has also already mentioned those reasons. I'll just paraphrase those reasons again for academic perspective, because we would like the participants to ask some questions and remember some things, say the PowerPoint may be helping them in that. So one of the points is that, the pandemic was one, war in Ukraine, second, supply chain constraints because of several reasons, one or the other. In fact, one of the major crises is the semiconductor crisis. The other crisis is the prices of metals like, nickel or copper, aluminium, something like lithium. Now, recently, Toyota, brought in a new vehicle. I'd like to mention it here. Now, the question I pray that Mr. Vikram Kirloskar's soul rests in peace. And I was a big fan of him because Toyota has the technology. He brought into India something called a hybrid technology, a strong hybrid, which does not work on lithium batteries. And this is basically nickel metal hydride batteries, NiMH batteries. And he mentioned, the Toyota MD also mentioned later on, that this we will not be affected much. But yes, the issue is that all these new technologies which are coming, they are coming on the back of commodities, right? And these commodities, whether they are metals or others, when they are not available, they create a crisis. Today, for the first time in Indian history, there is a waiting time on cars which runs up to 2 to 3 years. This, despite the fact that we are selling the highest number of cars, and that is a very good sign. We thank the government for holding the fort in these difficult times, despite COVID. As we came back from COVID, there was a real recession looming, but we are growing, and the sales of cars and scooters is one. Yes, of course, there is rural distress that the motorcycle and two-wheeler sales is not going as much up. But yes, supply chain issues has actually stopped us from growing even faster. Currency volatility is another issue which I have mentioned just now, which is affecting us together, which is leading to, so what, these causes probably are affecting the global economic scenario. This is also affecting the global, capital flows. So very quickly, the other thing which is going to affect us or the global economy is the rapid developments related to climate change. So there is one policy one day. So one president of US says that, no, we will have this policy towards climate change. The next president says that we'll have this policy towards climate change. And this affects the manufacturing environment. Why countries like India, where majority of the energy generated is from carbon intensive fuels, and we have, our carbon footprints won't be zero till 2070, as the estimate is, the way otherwise we'll have to, compensate for growth. But the fact is that this is something which we have to look into. So when we look into this, the commodity markets, we convert this whole action into commodity markets, we see that huge volatilities have been seen in the last few years. Energy and non-energy price, energy prices rising, natural gas, for example, and non-energy prices falling, metals and agricultural commodities. Natural gas prices, of course, rising. And of course, as I mentioned earlier, the crude oil prices are, not giving us that benefit that, crude oil prices have fallen, but the currency prices have gone up. Food grain production is robust globally, but is likely to fall in next few years. So these are some of the charts related to it that you have, a basic idea that yes, energy, agriculture, metals, these are the three areas we focus in commodities through organized exchanges, and they basically are about the global economy. Today, global economies are not as much about the equity culture or money flowing into one economy to the other in search for higher profits. Today, the global economies are more about movement of goods and services. And that's where, WTO had come into picture 20 years back. And today, the whole idea is unless there is movement of goods and services, and that's where, we saw China falling. As China fell, the global growth has been affected and global supply chains have been affected. So the other is the wheat and oil and wheat prices. Despite the lower prices, we have had a much higher growth. This is the changes in wheat and oil prices chart of different countries. Every country has suffered inflation in these terms. It has affected the money supply levels in these countries. Metal demand and growth. In terms of metal demand and growth, you've got, just see the volatility can be seen here. Grain supply is again another issue. On an average is the oil price forecast. Everybody suggests that the oil prices are going to fall. As I said, it's around 74. The fact is that, we feel that the prices, if they keep on a lower level, it'll be easier for the manufacturers. So same thing, the issue related to changes in oil demand around the recessions. In fact, the oil demand has gone up when the oil prices have fell, but we see that there's a lot of politics, oil politics, OPEC countries. We had the India-Russia case where there was a supply cap on Russia, the price cap on Russia, and all those things. So we look into it. So finally, as Sir mentioned, we had the idea of commodity derivatives. How do we really go about hedging our risk through derivatives? So if everybody knows that, when appreciation is feared, you buy futures contracts, and when depreciation is feared, you sell futures contracts. And these contracts are linear in nature. I'll give some idea, a small idea for the non-hedging people. But the fact is that futures are linear contracts. We have options, which are non-linear contracts. Options were more popular in the financial side, but 2-3 years back, options entered the commodity space. The options actually make the life of an investor much easier because they're easy to use, although difficult to price. In absence of data, pricing of even interest rate futures or options is very difficult. But in absence of data for commodity prices, how we do it, commodity futures, in fact, in organized exchanges, we have been able to largely find a very efficient way of pricing these options contracts. This has led to very strong response to the options market in India as well. So some of the pointers which I feel here, which to be mentioned for managing risks are that, if you manage volatility in metal, energy, and food grain, you manage your inflation. You may very well, the participants would remember that the government's policy has been a little unstable. Very recently, a ban was put on several commodities, leading to one of the major exchanges, NCDEX, affecting its operations on commodity derivatives getting affected very badly. National Commodity Derivatives Exchange. And, 10 years ago, 2007, 15 years ago, we had another Abhijit Sen committee. There also, they had put a ban on several commodities. And they said that commodity trading leads to inflation, which is contrary to the, experience. If you bring commodity markets closer to the investor, not the speculator, as I said, you bring it closer to the investor, then you don't need to provide them subsidy. They probably would be able to hedge themselves better. We have a long way to go on that in terms of, but for large companies which are into trading of metals for the oil,
Looks like we have lost him again. Yeah. Okay. Yeah.
Am I back? So, what I'm saying is, very quickly, I'm sorry for the unstable connection, sir.
Sir, sorry to interrupt. Can you keep your video off?
I'll do that.
So that, you will save bandwidth.
Yeah.
And if you can wrap up, Professor, in a couple of minutes, I'll be happy. Yeah.
So I think, what we can do is that the government has to basically go ahead and keep a stable policy and bring these markets to people. So what we can do is that, again, make the markets more transparent. Some of the points which you see here is that, typical commodity contracts which are available globally, some of them are available in India, not all of them, right? And we need to look forward to more innovations in the market, bring more products, as bringing of options has helped us out. And of course, as one of the key things is that you need to understand that while you are hedging through commodities, you need to understand that, if you have a proper risk management policy in place, and this is a chart which basically gives you an idea about what the policy should be, whether you look at the exposure aggregation, whether you look at risk quantification, look at the decision support or hedge ratios. I hope people here know this idea that, a right hedge ratio can actually bring your beta to zero in markets. So if you use a right hedge ratio, it will be a proper idea for commodities as well. So price fixing arrangements, rebalancing instrument mix, hedge transaction, etc. All these things. And finally, you will have an idea that you can, whatever you did was right or wrong. So you can do an assessment. So some of the final ideas which I believe, which you need to have are that, you need wider participation, you need innovative products, you need wider institutional participation, which is still lacking. We talked about mutual funds entering into commodity space. It has not happened. We talked about pension funds and other funds getting into it. It has not happened much, and this needs to be done. Of course, as sir mentioned, people hedge in exchanges outside India. We need to say that, yes, there are exchanges available. If you hedge in India, you are going to give us more liquidity. And if you talk about liquidity, you will also have depth. You will also have lower transaction cost for the participants, and that will be national service. And of course, definitely the exchanges and
Professor, we've lost you.
There has been a lot of innovation in India. The Commodity Derivative Committee has already introduced new futures contracts on aviation turbine fuel, weather, freight, cement, platinum, manganese, apple, cashew nut, garlic, tobacco, etc. But the fact is, a lot needs to be done. New products need to be developed. And of course, a welcome step that, SEBI has become a regulator for commodity markets. And we need to, revisit the idea of forward trading as well as the spot exchanges. So thank you very much, sir, for giving me time. And I hope that I was able to finish in whatever time. And
perfect. No, thank you. Thank you very much, Professor. And allow me now, I want to thank the professor for taking us through very, very interesting presentation and his thoughts, his ideas about the point that he made that those deciding on interest rates must look at the commodity exchange traded prices that will give them some cue about the movement of commodity prices, which would in turn impact inflation. I'm going to make a presentation. I have 3 or 4 slides to show. Please allow me a few moments. Yeah, here it goes. All right. What do I do? Let me. Where is the slideshow? Okay, all right. I'll make it full. Thank you. I think it's a delight for me to be part of this elite panel. As I mentioned earlier, of course, IMC is a SEBI accredited training institution for commodity derivatives. I happen to be an independent member on the SEBI CDAC, Commodity Derivatives Advisory Committee, since the beginning, and I provide a lot of inputs to SEBI for policy making. Anyway, now let me make a presentation. Some of this could be some kind of a repetition, but probably couched in a different language. But I enjoy writing and speaking on all this. We live in a VUCA world. The world today is full of volatility, uncertainty, complexity, and ambiguity. And each one of us, we understand what these words actually mean. And you cannot wish away VUCA. VUCA is there, present all the time. But we should learn to manage and navigate very deftly through these VUCA conditions. The next bullet point is something which is my favorite because I track commodities, I give price outlook, and I've been rather lucky and fortunate that more often than not, my price outlook turns out to be right. But of course, that comes with a lot of experience and research. It's art, science, and experience that actually matters when you do price forecasting. There are 6 key drivers of the commodity market, which we need to track and we need to be very clear about. One is economic growth, the positive correlation between economic growth and commodity consumption. I mean, I can dwell on this for half an hour, but that's not the idea. I just want to flag the correlation between economic growth and commodity demand. Second is geopolitics. Particularly geopolitical instabilities tend to impact the energy markets. If they are centered around large energy producing countries, then obviously geopolitics would impact energy market. And because energy products like crude oil are universal intermediates, they tend to have a knock-on effect on all the markets, including, of course, commodity markets. For geopolitics is something we need to track and its impact on commodity market. The third one is monetary policy. When you have a low interest rate, when you have too much money flowing in the market, obviously a part of that would go into all the assets. And commodity derivatives have now become an asset, say in the last 20 years or so. So we need to track monetary policy, which is very important, the levels of liquidity and the levels of interest rates, etc. And there is a relationship between monetary policy and commodity prices that I think Professor Pandey also talked about. Currency, of course, is an important driver of commodity prices. The dollar value is a very critical driver of commodity prices because most of the trade takes place in dollar terms, and the dollar, if the dollar were to weaken or strengthen, it would obviously have its impact on particularly emerging market currencies, which will again impact the import and export trade. Therefore, we need to track currency movements and have a fairly good idea of where the currency markets could be going. Weather, for agriculture commodities, weather is a very critical driver of the commodity markets. For example, we've had triple dip La Nina. We had La Nina early 21, we had La Nina early 22, or late 20, late 21, and even now we have La Nina, which is actually creating dry conditions in South America. While that La Nina brings wet weather to South Asia and Southeast Asia, it creates dry conditions in South America, Brazil, Argentina, and other countries, which obviously would impact your soybean prices, your corn production, wheat production, etc., etc. We need to track weather. Last but not the least, of course, is funds, the role of funds, how they are deployed in the commodity derivatives market. And there are techniques, so there are ways how to track the flow of funds. And now in the last 3 years, we've also learned a new disruptive force in the commodity market, which is, of course, transport disruption or shipping disruption. And we know what happened in 2020, 2021, and even now about these disruptions. So these are things that anyone interested in commodity markets, anyone having exposure to commodities need to track very importantly. This is something I referred to earlier. Yes, US-China trade war 2018-19, many of us actually underestimate the impact of the trade war, which actually dislocated a lot of supply, established global value chains. And it also disturbed the flow of goods and services. It stopped supplies from certain origins. It stopped supplies to certain destination markets. And of course, there were newer origins that came in, all that. Second, of course, COVID-19 pandemic 2020-21, all of us know how the WTI price in April 2020 went into negative territory. Have you ever heard of negative commodity prices? It went to minus $37, and then of course it recovered, all that. The pandemic has had its own impact, huge demand destruction across the world because of lockdown and movement restriction, etc. And therefore that impacted commodity prices negatively. There was a collapse in commodity prices, as all of us know. even as we thought, in the second half of 2021, because the world had large scale vaccination, most countries, there was a feeling in the last quarter of 2021 that, okay, COVID is possibly behind us, and restrictions were eased, and there was a renewed boost to business confidence. Therefore, that had an impact on commodity prices. Demand started to pick up after a miserable 2020 and early 2021. In the second half of 21, demand started to pick up. But the whole thing, the commodity markets were completely spooked from March onwards because of the Russia-Ukraine war. And these two countries are so critical for several of these of the commodities, including energy products, including metals, and including agriculture. And for that is now the war is going on, and that is still dislocated a number of supplies of a number of commodities. And then you have sanctions, you have protectionism, and you have destination markets are looking for new suppliers. The origins are looking for new buyers to actually beat the sanctions on Russia, for example, and the continuing sanctions on Iran, for example, on crude oil, etc. All that. And now, after as Mr. Rati pointed out, the US dropped interest rates very to the lowest level possible, 0.25%. And obviously that resulted, the quantitative easing resulted in too much of liquidity. Inflation started to catch up. And now in the last, since the first or second quarter of this year, interest rates are going up because in the US, inflation reached a 40-year high, more than 8%, which the US doesn't tolerate that level of inflation anymore. They are comfortable with something like 2% inflation. Therefore, the latest situation is what? High inflation, high energy prices, tightening monetary policy, interest rate hike, and a very looming recession risk. My sense is the EU or European Union is already at a threshold of recession. The US, probably it will take some more time, but we'll discuss it. We'll discuss it towards the end. But more important from the demand side, not just the looming recession risk, but slowdown in China and the concerns relating to renewed attack of COVID and lockdowns of several cities in China. Of course, there are protests, as we all know, in China, but the fact remains that there still are restrictions. So we need to understand the backdrop for commodities. Now, here is a table where I've taken a price of key commodities in November 2019, 2020, 2021, and 20. See how commodity prices have moved. Look at the crude oil prices. See how volatile it is. How volatile it has been. Look at copper prices. Amazingly volatile, from 5,900 to closer to 8,100. And then look at cotton. Extraordinary movement. And of course, in the last 3 years, we've seen November prices of gold have been fairly range bound, but 2019 it was 1,450, and therefore I think these are all on record, and prices have been changing with what I call kaleidoscopic rapidity. Every day, every week, every month, prices have been changing because there are new factors that are coming into the market. They play in the market. So what would manufacturers do? What would consumers of commodities do? What would even producers of commodities do? What would SMEs and MSMEs do? SMEs that who have exposure to commodities, energy products or industrial metals or agriculture commodities. What would importers and exporters do? I think that's a big challenge for the value chain participant, and that's what we're going to be talking about. Markets are caught in storm, and this storm was the severity of the storm was not expected. Okay. And therefore, these rapid changes in the marketplace in the last 3 or 4 years have completely unnerved all the value chain participants, which is whether is a producer, whether is an industrial processor, whether is a consumer, importer, exporter, trader, even a financier of these operations. All the value chain participants are feeling quite nervous about what has happened in the marketplace in the last 3 years or so. And therefore, this volatility in prices of commodities, and particularly key commodities, is a big challenge for all businesses. And I know for sure, because I work amongst SMEs and MSMEs, that they are probably the worst hit. And we cannot wish away price volatility. It is in the very nature of commodity market. Price volatility is in the very nature of commodity market. If there is no volatility, there is no commodity market. Put it that way. And therefore, all the value chain participants who have exposure to commodities, whether as a producer or processor or importer, exporter, industrial consumer, whatever, they need to learn to manage the prices. And that's the purpose. We constantly do at IMC and MCX together all the time, try and do awareness programs amongst value chain participants for hedging their price risk. And therefore, how do you manage price risk? Hedging is the only scientifically tested, time tested, scientific way to manage your price risk. And that's exactly what market participants need to, or value chain participants need to understand. And often people think, "Arey yaar, ye hedging kya hota hai? To sattabazi hai." This is, I'm sorry to use a strong word, it is a stupid thought. Hedging is not speculation. If you don't hedge, you're speculating. Hedging is not speculation. Not hedging is actually speculation. And this is the message I constantly give to market participants. Okay. Then let's go. Okay. Now, one is hedging by using an exchange traded contract for managing your price risk. But that contract, a derivatives contract, certainly the primary purpose of the derivatives contract is hedging. That is to manage price risk, lock in profits, lock in the built-in profits, etc. But there is another purpose of this derivatives contract, exchange traded derivatives contract. It is also an avenue for investment. Okay, and therefore, beyond hedging, commodity derivatives contracts are used for investment purposes also. That is because commodities have now become an asset class. When we talk of an asset class, when we talk of investment asset, everybody thinks about the equity market. Yes, equity markets are important as an investment asset, but commodities are generally perceived as consumption asset. But recently, in the last 20 years that I've been tracking, commodities have also now become an investment asset. Gold, for example, is a classic case of an investment asset, because many of the commodities have often outperformed even the stock market, even the equities market. And therefore, they are becoming quite popular. But if you want to invest in commodities during these VUCA times, during these volatile times, it is extremely important for the market participant that if you want to be an investor, yes, I'm sure one can make money, but you must have adequate product knowledge and market knowledge, extremely essential. And your trading decisions, your investment decisions must be based on sound research and commercial intelligence. I think this is the kind of message I want to leave for the participants. And therefore, let me stop here. Let me say good luck. God bless you all. I have a disclaimer to make, which I do every single time. I am not a trader. I don't hold any trading position either in the physical market or in the derivatives market. I'm a student of the market. Also, I'm often a teacher of this market. And I'm on the SEBI's advisory committee, and I provide a lot of inputs to SEBI for policy making. Remember, remember, in the last 3 or 4 years, SEBI has taken a number of initiatives to deepen and widen the market. All of us know index trading has been permitted, options trading has been permitted, mutual funds are allowed, AIF category 3, alternate investment fund category 3 is allowed, PMS is allowed. All these are attempts to deepen and widen the market. And yet my sense is that I think we still have a long way to go. There's still a huge opportunity for the Indian market to expand the space in commodity derivatives, and that it is so necessary for all the corporates and for all the SMEs and other industrial organizations who have exposure to commodities to come, realize, understand the importance of hedging and price risk management. So I will stop sharing the screen. I'll come back, and I'm going to talk about. I'm going to ask actually, Rati Saab, I have some views, but would you share your thoughts on what is likely to happen, say in the first half of 2023 and possibly in the second half of 2023 from a commodity market perspective, or even from a global asset market perspective? Any thoughts top of mind?
Yes, I think, as I said, US, Europe, many countries, developed countries are definitely going to face very difficult economic times.
Yeah.
And they will sort of be like recession.
Yeah.
So I expect that commodity markets will, prices will remain subtle only on they unlikely to go up very high, at least for next 1.5 years. And that's the time for India to take advantage. When, global demand is less, we can take advantage of it. Even China is having, their economic growth is down. So today is a great opportunity for India. And, but that's on the commodity markets. And actually when commodity markets, when raw material prices are lower, I think most of the Indian companies will do well, barring metals and, commodities where the finished goods itself is metal.
Yeah.
My view on the, obviously, stock market is optimistic. I think market will continue to do well because there is good performance coming from the corporate sector. I think the growth is there. New capex has started coming, credit growth has started coming. So on the whole, Chandrasekhar, I think India at least is looking for a good year ahead.
Right, correct. Professor, any thoughts on the outlook for 2023?
Well, I think the first thing is that we would like the Ukraine war to end as early as possible. We'd also want, China to ease COVID curbs. China is one of our largest trading partners. Global growth is largely dependent on these factors.
Yeah,
and that is the third part is that the looming recession in the West may affect our exports, which affects ultimately the commodity markets. So what I feel is that, these geopolitical factors, they are going to keep us in some trouble. That is the estimate also. But, as they've said that the inflation may rise up to 8.8% and they then fall back to around 4%. But global growth itself, so my idea is that India is largely insulated from majority of the global changes, has been. If you look at it, we still had last 3 days when the US markets were falling, India's markets were going up. Yesterday was a good day for the investors. So what I feel is that India largely is insulated because still we don't have a full capital account convertibility. We still have rupee performing better than other currencies, emerging market currencies, as far as dollar rates go. So, one of the key only idea is that energy needs, 80% of India's crude is imported. So I feel that this is going to hurt us in some time. Crude prices are of course down. India needs to have, proper association with the South American countries. Probably our association, we have done good diplomacy on the crude oil front. It could have actually plunged us in real trouble had we not bought oil from Russia. But yes, commodity markets are going to be in for trouble because they are largely affected by the geopolitical circumstances. And I don't know if we assume that in the way we are going right now, in terms of capex and credit growth, if it continues, so we do not have to worry too much in at least next 4 quarters.
All right. Yeah. Thank you. I think that's a good summary. My sense from a commodity market perspective is that I would divide it. 2023 will be a year of two halves, is what I'm thinking. In the first half, first 2 quarters, I expect inflation to continue to stay at fairly elevated levels. The US Fed will continue to tighten the monetary policy, that is, will continue to raise, although it's going to slow down. It's going to slow down. December possibly, one can expect 50 basis points. And for next first 2 quarters of next year, maybe it could even taper further down. There, I expect a pivot to come sometime in June and not before June. And of course, all the US decisions are data driven. And therefore, because the labor market is still very hot in the US. The point therefore is sometime in the second quarter of 2023, the signals will get much louder. By which time Europe would have already been in recession is my reading. And at that is the point of time, where I would think the Fed would not only pause the interest rate, the Fed may be forced to actually drop interest rates. This is my call. So that can potentially happen in the second half, maybe June, July, August, whatever, in the second half. When that were to happen, the dollar, which has already now started to weaken, it was at a 20-year high on parity with euro, is already weakened slightly, it will weaken more. And when that weakens more, it will actually lift commodity prices in some way. We'll come to the demand side later, but that will help lift commodity prices. And that will also have an impact on emerging market currencies, which means our rupee has a potential to actually gain strength when the dollar starts to weaken further. I am quite bullish on energy prices. I don't see a Brent coming to $70 and that kind of level. So it may not go to $120 either. But I would think if I were in business, and fortunately I'm not in business, nor am I an investor, but I would think it could be between $85 and $100 Brent is something one should expect. The OPEC has a meeting on the 4th. And I will not be surprised if they take a decision to cut production further. And the EU sanctions on Russia are going to kick in the next day. That is December 5th. And therefore, that can also potentially impact production in Russia. And therefore, I think there are so many uncertainties. The energy market is completely at a crossroads, and we don't know. But if there is a risk, or if there is a directional change, my sense is the directional change could be to the upside and not to the downside. Yeah. But a weakening dollar will also help gold. I'm expecting gold prices to get a fillip. Gold prices would go up. I'm saying this, obviously, there's a huge amount of interest in MCX in both crude oil and precious metals. And recession, yes, obviously it's going to hurt everybody. As the professor rightly pointed out, India's exports are going to take a hit, which is very sad. And therefore, we must now look at strategies to slightly move away from merchandise exports to services exports. Whether anybody in the government is thinking about all this, I still don't know. And whether it's even possible to quickly move to services exports, I'm not very sure. So I think, but I think we are going to have tough times. It's not going to be comfortable. It's going to be very, very uncertain. The VUCA times, as they say, volatility, uncertainty, complexity, and ambiguity is going to continue. and therefore people have to navigate, people have to stay safe, and people have to, as I say in football, cover their flanks, and for those with commodity exposure, derivatives market offers a wonderful hedging opportunity. So with this, I think my friend Naveen has been raising his hands, and Naveen is somebody who's so closely associated with the commodity market. Naveen, you have any thoughts to share? We'll then go to the questions.
So very good evening, Chandrasekhar sir.
But very quickly, Naveen.
I'll be, sir. Thank you, Professor Pandey and Rathi sir. Chandrasekhar sir, I don't have a question, but I have a suggestion only.
Some observations, please make.
Yeah, there are two things which are impacting the hedging currently on the Indian markets and why the people are moving out in the overseas market. First thing is that we don't have the liquidity on the far of the month contract. So if you're about the corporate, they're looking forward for contracts maybe 3 months or 6 months down the line. They don't want to roll over every single contract 3 months. That's a cost. And the other part is the SEBI has come out with the guidelines late some time back that they have made it voluntary for people under the listing guidelines to their exposure in
LODR,
the LBDO, LBO guidelines, which have recommended corporates who are part of the commodities business as to what their policy and the hedging mechanism is. And if that is just the voluntary, I think if it can be made through the IMC and RBI and SEBI, the mandatory aspect, I think whatever we are talking about for last so many years for people to get into on hedging would be something to look forward to. Thank you.
No, thank you very much. Point very well taken. Yeah, we'll take it up. I'll probably in the next CDAC meeting I'll mention. I thought this was not voluntary. This LODR declaration, the companies are expected to announce in their annual report how much is their hedged position, how much is the unhedged position. Whether they're actually doing it, I don't know, but I don't read annual reports of companies. But somebody must do this exercise and identify companies which have exposure but not giving a declaration or giving a very perfunctory reference to their exposure. But point well taken, Naveen. We will do that. There are some questions. Let's, of course, we have probably 5 more minutes, and therefore let me post your question. Good evening, sir. I want to know how to analyze scarcity or how to analyze future price of commodities. This is a question from Dhruv. Dhruv, it's a big question. In the next 2 minutes, we can't. It is not possible to explain how to analyze. Analysis is art, science, and experience, as I said. First of all, you have to study the commodity market dynamics. You have to study commodity market drivers, find out, have adequate product knowledge, have adequate market knowledge, look at who are the big producers of commodities, who are the consumers of commodities, what is the supply chain, what are the factors that affect these commodities, whether it has relationship with economic growth, geopolitics, monetary policy, currency, weather, all that. You need, and therefore it's a big exercise, and therefore it may not be possible in this kind of an event. But we will at the IMC will certainly be doing a lot more awareness program and introductory courses on derivatives trading for risk management. I'm sure you will be there in our database and mailing list. How to identify rumors? I don't know. And when you admit that something is a rumor, so I think you should ignore it. Okay. All right. Can you please? Okay. Why FPI is not allowed to participate in Indian commodity derivatives market? Naveen, you have any thoughts? Foreign portfolio investors?
So they have been allowed very recently.
Yes,
so
exactly. That is
recent, I would say a month back or so.
Right.
Sir, I would say just to add on to this, that even the AIFs are allowed, the commodity derivatives,
AF category 3. Yeah.
the mutual funds, the AMCs are allowed to take an exposure
Correct.
on the commodity derivative.
Correct,
It's a
correct,
very recent one, just an added thought, sir. All would make a purpose from the
Correct.
institutional side to
Bilkul,
participate is
bilkul.
the liquidity in the farm.
Very true, very true. What impact will global recession have on Indian economy and commodity market? Professor Saab, any thoughts on that? Any response to that question from Dr. Parvati?
Again, sir, what impact will?
Global recession have, it's in the chat box. What impact will global recession have on Indian economy and commodity markets?
Oh, very simple. You are part of a globalized world. When they used to say when US sneezes, the rest of the world catches cold. So the fact is that there is some impact, but as I said, that we are largely immune to recessions. Like when the entire world went into recession due to global financial crisis, India was the only economy doing well, because our economy is largely inherently strong on some reasons. There is, of course, like a 30 crore middle class which runs the economy. Then agriculture, you don't know probably the facts. This year, the agriculture has performed extremely well. The services sector, largely a services-led economy, out of the total GDP, majority of it now comes out of services. So, services, manufacturing, agriculture, the only problem is manufacturing is a small part of our economy. That makes us a little safe from the global headwinds. As the role of manufacturing in economy rises, you immediately catch cold the moment anybody sneezes. So the fact is that we are a little safe. Our agriculture is doing well. Our services sectors are doing well. Services PMI is up. So what I believe is that not much of an impact right now. We need to be careful, or we need to open up. We need to manufacture a lot in our country. We need to have faith in our markets. And I'm happy to say that investors do have faith in our Indian markets, and we are reasonably doing well. Savings rate is high. Indians still, do not want to, despite, I'm not too sure about the Generation Z, but my father taught me not to stretch my feet beyond, the chadar I have.
Right.
So the fact is that, people do save, and people do have right. So as long as the saving investment relationship goes, the country will keep doing well.
Right, that's right. Very point taken. But the global recession will surely, in fact, you yourself said, will impact India's export.
Will impact, what I say is, for next 4 quarters, we have to see, the fact is that there will be some impact, but not much. India, the problem is you are talking about India's growth. Just imagine we are approximate $3 trillion economy.
That's right.
And even if we keep growing at 6%, it's not a good growth. We need to grow at 15%.
Absolutely. That's
right.
And
you keep comparing with US, with or China.
Absolutely.
China is a $15 trillion economy.
Exactly.
Their growth is, even at 3 percentage point is much higher than us.
Absolutely.
So, all this talk of PPP basis economy and everything is fine. But if you really wish to have the economy growing, I see 6% growth, not a good growth level. We have to grow at, 8 to 10%. And that may happen.
Right. I agree. Whether that will happen, there are question marks, there are headwinds, there are roadblocks, I can imagine. But if the person asking the question, Dr. Parvati, is from Somaya institution, then she knows me, so she can engage with me offline. I'll share my thoughts. Then okay. I think we are probably coming towards the end of this. There are no more questions. Knowledgeable session, very interesting. Thank you. Why hedge funds are not there in India? Any thoughts, Rathi Saab?
I think obviously it depends on the investment portfolio. I think hedge funds are, some people are not calling them hedge funds, but they're acting as hedge funds. Okay.
Right.
I think let them not be called. I think basically hedge funds are taking a short-term view on that.
Yeah.
And many AIFs are, working on that.
Correct.
They have a short duration, outlook.
Correct.
So I think so long as we can take a view on the markets, whether commodity or equities, which I think notes we have sufficient good participation in the market.
Right.
The liquidity is good, and therefore I think one need not really be concerned about this.
Right, very true. Thank you. I think we are actually coming towards the concluding part of our webinar today. But before I say anything, I want to Professor, any parting comments very quickly, half a minute? Any
Well, I'd say,
advice, parting comment?
I'll tell you, sir, one thing is that we got to get our act in order. The policy of the government on commodity markets has to be as stable as, and thankfully, SEBI is now doing good things here. Technology has to have a major role. Our technology on the exchanges needs to improve.
Correct.
We need to have the best possible platforms on which people trade.
Correct.
And we need to have, probably someday will come when commodity investment would be as popular with people as equity culture. And that's going to save us a lot of trouble in terms of hedging.
You said it. In the United States, commodity markets are bigger than equity markets. That's it. Rathi Saab, any final
No,
comment?
I think I would only say that, yes, I am bullish on the economy. And I think little different view than what was said about the impact of recession. I think that might be a greater opportunity for India, where the commodity prices are lower. Also on the oil, Chandrasekhar Saab, I have a little different take.
That's okay, sir.
I think
it's a view. It's a view.
I think that if the economies are recession, oil prices are likely to be closer to $70, $80, and which is what we need. And I think, in long term, these cartels, OPEC, everything, when prices go high, everybody breaks the cartel, and want to supply more. So I think they don't work in long term.
They want market share. They want more.
And also in long term, sir, understand that there has to be a relationship between cost and selling price.
Oh, absolutely.
You see, if the oil cost is, let's say, $40 or around, correct. You can't sell it for $100 forever. It won't happen. And more my view on oil is that should be closer to 70, 80. So I think all I'm saying is I'm very optimistic about India. Not only in short term, but long term. But next 1 year is interesting.
When we talk about long term, maybe 2025, 2030, very clearly all countries are committed to decarbonization. And when they're committed to decarbonization, they're moving towards renewables. Therefore, demand for fossil fuels will decline. And therefore, fossil fuel prices will have to decline inevitably. But that's, in my view, at least 5 to 10 years away. But we can, I understand, which is fine. Therefore, let me thank Anand Rathi Saab for his erudite exposition and sharing his knowledge about markets. Professor Alok Pandey has been so eloquent and so clear about whatever he said about the markets. Thank you very much, both Rathi Saab and Professor Pandey. I want to also thank all the participants. I want to thank Naveen and several of the participants who raised questions. And therefore, with this, we will conclude today's webinar. I'm sure we will keep doing this more often. This is, after all, sharing of knowledge for the benefit of value chain participants, market participants, members of IMC, and everyone else. Therefore, with this, let me say good luck. God bless you all. Stay safe until we meet again. And we'll now conclude the session. Thank you.
Thank you, sir. Thanks everyone.
Thank you.
Thank you, sir.
Thank you.
Thanks, Anita.
Thanks. Anita, thank you very much. I want to thank Team IMC. Team IMC, Anita Naik, our IT department, all these guys have done a wonderful job. Thank you very much.
Thank you, Rathi sir. Thank you.
Thank you.
Thank you, Professor Chandrasekhar.
Thank you. Yeah, welcome. All right. Awesome.